Welcome to the Lone Star Capital Podcast. I'm Rob Beardsley, founder and principal.
And I'm Craig McGrother, Director of Business Development,
On this show, we talk about real estate investing, business,
and so much more.
We are back. We are live. Happy Monday to you and yours and everyone you're with. I am Craig McGrother, the host of the Lone Star Capital Podcast, here today alongside the founder and CEO of the firm, Rob Beardsley. How are you today?
I'm doing well, thank you.
Excellent. Well, I hope everyone's enjoying sifting over new deals and looking at new horizons and opportunities here. Before we get into the podcast, we're going to plug ourselves here. We are almost a month away, about 5 weeks away from the Lone Star Capital Summit. This will be the 5th iteration of the event. We already have a ton of people locked and loaded, ready to go. This will, without a doubt, be the best group of individuals who have attended the event due to the list so far. Tickets are selling quickly. There's only a limited number of individuals who will be able to attend. So if you're thinking about this, if you're considering attending, get over the fence, get over the hump. We're very close to selling out. We're close to full capacity. There's still a bit of room left at the moment, so please reach out. But Rob, what can people expect if they come to this event? What will be better? What will be different in your opinion, as you're obviously very keyed into the agenda?
Yeah, well, we have sticked to a pretty standard format throughout, which I think has served us well because we've just continued to refine and iterate and improve. So, like you said, really the heart of any event is the people. And like you said, we're going to have better and better people every year. That's what we strive to do. That is true as we grow our network, as we grow our reach. And as Lone Star grows in its experience and its network, we're able to turn around and share that with our extended network and with the attendees of the summit. So definitely looking forward to bringing everyone together. And then it's always good to talk about current events. And there's a ton to talk about seemingly the last few years. And this year will be no exception. So I'm looking forward to getting into discussions about latest and greatest on legal stuff, debt, equity, right? The capital markets as a whole, operations. So that's going to be probably the most exciting thing aside from the networking.
Yeah, and I think one thing that kind of came to mind that we hadn't talked about before, as we wanted to discuss this obviously big event that we're about to throw here, which is the typical real estate conference and our conference. Typical real estate conference, a whole lot of people. You may talk to one person that's of value to you. You may meet one person only. You may get there and it can feel a little overwhelming or underwhelming. It can be either a ton of people or you're like, wow, the vibe here is just not right. There's no aura, there's no buzz around this event. And I would say most events feel that way. Most events are, well, why did I come here? Did I actually get my money's worth? Did I meet someone I can actually transact with? I have been to, basically every big real estate event, whether it be NMHC, whether it be IMNs, whether it be Raise Fest, Best Ever, whether it be Biz Now's Ascent and whatnot, these are all good events, right? So
Big deal.
we've been to all of the big ones. And what we essentially did is we scraped together the best attributes to this event to give you the best experience possible. What does that mean? How does that make your dollar work and your time work? Number one, you're going to get curated meetings with people that you're looking for. And the beautiful thing about this is that this is invite and application only. There are no random people here that are just filling the room that are going to suck and waste your time. So anyone who came into this event, anyone who is attending this, is going to meet with people that would directly do work with them or would be a resource for that individual. And we are setting you up with around 10 meetings there, plus small group discussions. And then you can go over to myself or Rob and say, hey, I am so and so and I'm looking for X. Is there anyone who can help me point me in that direction? And you get to work directly with us, okay? And we can help you in that regard. So we're going to have institutional capital partners there. We're going to have institutional level high grade sponsors there, the best vendors, boutique fund managers, LPs, everything there you're looking for that could be possibly beneficial for you and your business. You are going to have access to that and kind of be able to infiltrate the best of our network. Obviously, it doesn't come for free, but so long as you get through the scrutinized vetting process of being accepted through the application process, we would love for you to come and to be a part of our network and contribute to it. And, we can't raise every single dollar for every person we work with. We understand that there's allocation allotments that individuals need in relation to that, and every dollar can't go to us. So if it's not going to go to us, it might as well go to you. And the people that are coming to our event are looking to deploy dollars or working to work with individuals who are looking to, receive capital, everything of that nature. So you get wined and dined with the best of them in New York City, in the best office in the city, in the best conference space. You're getting legitimate and tangible people you will actually be able to work with from this event. I can't tell you the amount of people that come up to us or message us saying, hey, I just want to let you know, and have expressed feedback about their gratitude and appreciation from coming to our event, to meeting capital partners, transacting with them. So this is such a blessing for all parties involved. And we don't know how long, or if we're going to do a ton of these in the future. That's not being hyperbolic or being silly, as someone in this conversation may have said last year was going to be the last year. However, we're at least going to do it for one more time. We don't know how much longer this is going to be. So if you're thinking maybe I'll catch the next year's, there might not be a next year. And that's me saying that now, but there could be, there might not be. We work very hard on this event. It's very time consumptive, but the person who gets the most out of this is you, because from a company perspective, Dasha, myself, and Rob and the team spend thousands of hours, which is a lot, and you just get to spend X amount of dollars to come to our event. We would pay whatever the price would be. You could say it's $10,000. Rob, I think it's pretty safe to say that you would spend $10,000 just for the ticket, not even including room and board, from someone like myself or Sam or Dasha or you or Brad to go to this event to maximize the value. Is that a fair statement to say?
Yes, it is. And I would just end on this point. We don't host the event. Like you said, it's expensive to come, and life is expensive with taking the time out of your busy schedule to attend an event. You've got to travel. You're going to mess up your routine. You're going to pay money for a ticket and a hotel and a flight. So with all that being said, we don't do it because our ticket is expensive and we plan to make money from the event. We break even on the event. So the reason why we do it is because we believe in the power of network, and we believe in investing in our network and growing and bringing people together, because we have seen firsthand, we have examples of the benefits. For example, a group comes to mind where they attended, and then actually from the connections at the event, they were able to raise millions of dollars from one connection at the event. And then in turn, this firm, we actually hired one of their asset managers who was moving to New York. And so we got the referral, the introduction. And so now we have a great asset manager on the team. They got a capital partner where they raised millions of dollars. And so everybody's winning and everybody's growing through this mutual network.
Yeah, and obviously we can't guarantee what you'll get from coming to the event, because different people are going to get different results. Some individuals are going to be able to really rake it in here. And kind of the final thought here is take it from someone. And if you're really seasoned, if you're in this space, you know exactly what I'm talking about. But the forced has burnt. It is burning. It is still going to burn. And those who are deploying capital today are not the same people in your old, dusty, crusty database. Okay. The people that you worked with 4 years ago, 5 years ago, 3 years ago, maybe even 2 years ago, heck, maybe even a year ago. A lot of these individuals get chewed up and spit out by the market, and that's happening in real time. So, do you want to know, if you're a sponsor, who the real players are? You want to know who's actually deploying equity right now? Do you want to know who are actually people we're working with? Well, it's probably the people that are spending thousands of dollars to come to our event. So if you're a sponsor, think about it from that perspective. And if you're an equity provider, who are the guys that are actually playing offense right now? Who are the guys that are actually trying to buy deals right now? Trying to work with people like yourself that are trying to put stuff together right now, and they need you to support them. But these things aren't free. Obviously, I'm not trying to make this a whole price conversation, but the value that you're getting out of this event, should you show up, be present, and bring your game face, you will easily recoup your investment into that there. As I said, I know everyone who's coming, as does Rob, as does Dasha. We vet this whole room. I will be personally, along with Rob and Dasha, setting up meetings for you to meet with whatever you are looking for. So it's actually silly that I have to sell this to anyone, quite frankly, because as I said, I wish someone would be, like us in many respects, although impossible to duplicate. I wish people would be like us and set up these in this high level of an event. Often and routinely we hear, yeah, that was the best event I attended. I actually got the most out of it. I actually am going to work with some people here. Imagine if you could do that. We would spend so much money on that. But of course, if you want something to be done a certain way, you got to do it yourself, it seems. And that's exactly what we're going to do here. But That's me on my soapbox talking about our summit event, September 14th and 15th. Go to our website, learn more there, apply, try to get accepted, try to get in. We want you there, assuming you're qualified. All right. So, that said, we're very excited because perhaps if you look and have seen our emails at this point, you'll notice something new that we're working on. And we did get one question from some investors and whatnot, which is how value can be created on a deal. And one of the comments was is that, hey, I'm confused. Is the only way this deal is making money is from boosting up the extra income on the property? So, Rob, let's get into this and talk about, is this a great business plan? Is this too much of a one-dimensional business plan? Does it make sense? What is your take to that comment? Because I think you had um, a spirited thought, and this got you, dare I say, a little bit worked up and not aggravated, but put a bee in your bonnet, if you will.
Yeah. So when you kind of first get introduced to the multifamily business, the first word you learn in the business is multifamily. The second word you learn in the business is value add. So value add is essentially the business plan that everybody knows, and that's the only business plan that exists. And what that specifically refers to typically are interior renovations, perhaps amenity upgrades, essentially raising rents. That's really what value add means, raising revenue. So, and
Forcing
that,
appreciation.
yeah, and that worked really well, and it can continue to work really well, but it's not a given. And we can kind of go back and forth about the merits of that, but let's just kind of quickly go over the fact that raising revenue is very difficult uh, when we talk about it in a vacuum. Of course, the market, especially when you're investing in high quality growth areas like primary markets in Texas, you're going to see rent growth naturally over time. And that's going to help you. And that's why we invest for the long term, because we have natural tailwinds. We don't have to, yes, we have to work our butts off every day just to keep things kind of operating well. But over time, we know that the market's going to take care of us and grow naturally. But outside of the market naturally growing from a rent perspective, the value add typically more specifically refers to actually, forcing appreciation or forcing rent increases by way of renovations and improvements. And this is speculative and much more difficult than people give credit for. It's speculative in the fact that, of course, there's no guarantee. You can spend the money, you can renovate the apartments. Is there a guarantee that there's going to be a tenant there to rent it quickly at the price that you want? Now, that's why we do comps. We do a market analysis to figure out, okay, this is reasonable. We have the data to support that this renovation will yield this result. However, we all know what we can do in spreadsheets is manipulate them. We can get the numbers to say whatever we want. And so like a person holding a hammer, everything starts to look like a nail. So if what you are is basically like a chop shop where you're just going in there and you want to just renovate, any unit you see is perfectly good, appliances, perfectly good countertops, whatever. It's like, nope, rip it out. We're putting in the stainless steel. We're putting in the backsplash. We're putting in the new countertops. We're painting the whole thing. We're doing the new floors. Why? Well, it's because we make 20% margins on our construction side of our business. So are you a investor? Are you an operator? Or are you a construction company
Yeah,
that's
are
looking to
you
create
a fee
margin?
clipper?
Are you a fee clipper? So that's getting kind of down another path that I don't really want to argue down, but I'm just kind of speaking about the difficulties of value added. It's not a no-brainer and it's not a given. It is
And value
risky.
add, yeah, and I think value add really does make most sense when the market is kind of on the up and up and, only going in one direction, which is this way, right? It's going in at a positive light. It's very rare that value add deals make sense when the market is kind of staying flat or even rents are going down and there's a lot of supply going on. Because if there's a lot of supply kind of coming online in the market, there's actually a flight to better quality. People are actually trading up because these properties, rents will get stymied when there's more supply, so rents will stop growing as much, and these better quality places need to get rented, so they'll start giving you deals. So what does a tenant do? Well, the tenant says, yeah, that's a cool 80s vintage property that's got a new interior, but I can live in this 2000 whatever vintage property with better amenities, higher ceilings for the same price. Bye. So what does that mean? That means that all that money that you spent on repairing that unit is probably cooked. It is not an efficient use of dollars. That's not to say maybe you didn't buy the property well, but when you do a value add property, a value add opportunity, you're investing somewhere between, call it plus or minus 12.5K. When you put 12.5K in there, you are creating a market. You need to create that market. You basically are saying, hey, we're going to remediate the loss to lease, and we're going to basically set the market with some comparables and stuff. And there are deals that we've done. I mean, of the last, I want to say 9 deals that we've acquired, really one, which was Grand Revere in Dallas, was a true value add deal from a repairing units and acquisition perspective from a business plan. But of late, we've kind of found there to be better value in other places. And I think the conversation is about being as you mentioned before, relatively speaking, which is being open-minded in ways to create value to a property. This, is a multitude of things, and it takes a nuanced and savvy operator and acquisitions group to identify those properties. And ideally, the more properties that you have on your portfolio, you can see some discrepancies. And the way we're actually creating value on said property that this individual is talking about was boosting something that tenants were already requesting, and where there's already proof of concept in that market, not only within our portfolio, but within the surrounding vicinity and the comparable properties there. So, although it's one way that we're doing it there, this is the lowest hanging fruit item because it's not totally stretching out the tenant in relation to other options in the marketplace.
Yeah, so just to kind of finish on the revenue side of things, value add is not a sure thing. It takes time, it's risky. For example, you can have cost overruns because you can budget for interior renovations to cost X. They could end up costing Y just due to material cost changes, to labor, to delays, and things like that. And then, of course, the market and what renovated rent premium can you feasibly achieve. And also, it's not just for one unit; it's for scale, right? Because if you have a 200 unit apartment complex and you want to renovate all of those units and rent them out at higher rents, that's number one, going to take a long time, and number two, that's going to soak up a lot of the demand in the area for renovated apartments. So sure, could you renovate one of those 200 and then list it for rent for $200 higher and wait 2 weeks, 3 weeks, 4 weeks for that right tenant to come around and lease at that higher rate? Yeah, of course, it probably will work out. But to get every unit, all
At
200
scale.
units renovated, leased up at the higher rent in a timely manner where you don't have a lot of days on market for the rental, now that is not the same thing. So that is just kind of the one piece, but I actually have a much stronger argument coming up ahead. But first, I want to talk about the expense side because income is comprised of revenue and expenses. And so a much lesser talked about value add would be a reduction in expenses because you could buy, value add is all about buying something and making it better. Essentially, buying something at a certain cap rate and then operating it up to a better cap rate. That's the goal. So if you buy a 5 cap, you want to be able to work it up to a 6 or a 6.5 cap.
I have a
And
thought. Sorry, I'm cutting you off. It shouldn't be called value add. It should be called NOI lift. Value
no,
add's dead.
no, it shouldn't.
Net
It's,
operating income. How do you
no,
have more
I
operating income? You
no, I
disagree?
disagree. I disagree because
All right.
it's missing the most important component, which is return on cost. So I don't care if you can double the NOI. And see, this is really the crux of the problem. I've been kind of leading up to this point, and I'll just kind of skip to it because expense reductions are self-explanatory. You reduce expenses, you increase income. Good. And not all management companies operate properties the same. Shout out to Cortland. They're one of the best managers in the country, one of the biggest owners in the country, but they manage their properties pretty heavy. They have a lot of extra expenses that they have on their properties, and we can manage the same property more efficiently with less expenses, doing really everything else the same. But I digress. So going on to return on cost, that really is the crux of the matter. Because when I say I don't care if you can double NOI, if you can buy a property with $1 million of NOI and through renovations, through value add, everyone's favorite word, value add, you can make the NOI 2 million, that really matters not at all because what yield on cost are you ending up at? Because the problem is everyone is so fixated with value add. Everyone's so obsessed about it and everyone underprices the risk of value add. And what that means is that deals that actually have the embedded upside in them where there's proven upside in the comps, and the interiors are old. And if you do in fact change out the interiors and upgrade them, you will get higher rents. You are paying a massive premium for that. It's almost as if you're paying the post renovated price for the flip, right? You're buying a junky house that's a flip deal, but you're paying the rehabbed price for it.
You're paying retail price for wholesale product.
Garbage.
Yeah.
So that's why I say I don't care if you bought the deal for $1 million NOI or it has $1 million NOI when you purchased it and you value added up to $2 million. It's not about the lift. It's about where you end up from a yield on cost perspective. That's why I take such a big issue with all these value add deals and investors and owners, because they're favoring buying something that's more risky, takes more time, and you kind of end up in the same place. Because if I buy an old property that's a fixer for a 4.5 cap and then I fix it up to a 6 cap, well, what if you could just buy a 6 cap from day one, and then you take no risk, you do no work, and you end up assuming the properties are like for like and everything else is the same, right? Obviously you would take the deal with no upside if you can get it for the same yield on cost. And so that's kind of my issue with people who are still operating in this more basic level of, well, deal can only be a good deal if I'm massively, or to modestly, or even more so, improving the income of the property. It's not about how much you can increase the income of the property. It's about what your yield is at the end of the day, because increasing the NOI is not free. Like we talked about, you have cost, you have time, and you have risk. Those are all very expensive. And guess what? They've only gotten more expensive because interest rates have gone up, which means opportunity cost is higher. So the cost of time is more expensive. Costs have gone up so much. It used to be back in the day, you could spend $5,000 on an interior renovation and you get $100 rent increase. What's that? That's $1,200 a year of rent increase on a $5,000 spend. That's
You double your
24%.
money in a year. Yeah, it's unbelievable.
It's
More.
24% ROI, right? So nowadays, especially if you look at a lot of deals today exhibit the exact opposite fundamentals, where the seller is trying to sell the deal and pitch it to the market like, hey, this is a valued opportunity. And they went ahead and renovated a handful of the apartments, and they're showing, yeah, you can raise rents, renovate the interiors, dial it up to the nines, right? Well, the problem is dialing it up and spending all the money to make it all nice is going to cost you at least $15,000. And if you look at the rent roll and really analyze the rent roll, it's not a pretty picture. The renovated units have a higher vacancy rate, so they're harder to lease, they're taking longer to lease. And the average rent premium, actually, as compared to the classics in the same property, like for like units, I mean, we've seen properties at $50, maximum $100 difference. So would everyone is obsessed with value add and raising rents and renovating the kitchens and the before and after pictures, but would you really, with your own hard-earned money, buy a house, spend $15,000 renovating it for a $50 rent increase? We're talking about single-digit ROIs here. This is not worth it. I wonder if the NOI has gone up over that time, at the same time as value has gone down, which obviously that creates a really great recipe for success for investors today, because now you're able to get in at better valuations on basically like a better cap rate, which is necessary because we went from risk-free rates of 0 to now 4. So that is a meaningful difference in the capital markets. But yeah, I mean, we are looking at opportunities that are bringing us, into close to positive leverage territory, which is really, really exciting and very difficult to achieve. So I think that we've talked a lot about on this show about how negative sentiment coincides pretty well with the best timing opportunity wise. And so I think that we are kind of somewhere still in the midst there. I don't think that there's necessarily, you don't have to time the market like one point in time. And, we don't try to time the market at all. We try to be thoughtful throughout all cycles and kind of figure out where we are and kind of position ourselves accordingly. But, we're of course long-term investors. So I think that it's, it's a good entry point today. But my other perspective is I really don't like when people look at the fact that a deal has gone down in value by 20% or something as some incredible buy signal. Like, oh, this is an amazing discount. I'm getting in at the best price ever. This is the best deal. You should buy it now. Because, yeah, it's interesting the fact that someone's losing money and the fact that this deal used to be worth, if you're estimating worth by how much someone paid for it at one point in time, it was worth more before. And now you're buying it for less. I mean, that's nice, but it doesn't make it a good deal. So, unfortunately, to be very successful at investing, you have to be contrarian by definition. And you see right now, there's definitely some pessimism surrounding Class C property, older vintage assets, especially 1970s vintage assets. And rightfully so, there's reasons to be pessimistic. And I'm not even sure if we've really fully corrected, because the optimism was insane, right? People were so gung ho about buying junky product in bad locations and overlooking all the risk and issues, and assuming that these older properties would just keep going up and up and up in value. And so now that sentiment has really come crashing down. And so it is very difficult to raise capital for these sorts of strategies. I mean, I think if you go out to the market, whether you're looking to raise high net worth individual capital or institutional capital, fund money, whatever it is, if you're going to go and say, I'm going to buy, suburban 1970s workforce housing, I think you're going to have a really, really hard time raising the money, which is not necessarily an indication that it's a bad investment strategy. It's just simply an indication that the capital is not flowing there, which is actually interesting, because where there's going to be the best prices is where there's going to be no capital flowing, which is, said differently, less competition. So I don't know if we're fully there yet, because you need two people to tango, right? You need a buyer and a seller to make a deal happen. And so, even if you today said, you know what, I want to be contrarian, I want to go dumpster diving and go after these junky assets and, make a play on those. Well, you still need a seller who's willing to sell you that junky asset at the basement price. And we still have yet to see we haven't seen hardly any seller capitulation in that segment where people are really selling for those basement prices. Yeah, pricing has come down, but we're not talking about steals as of yet. So I don't think, we're fully there yet as far as that opportunity goes. We've been talking about the revisions to the monthly job reports and the different reports from the ADP payroll to the government, non-farm payroll and things like that. And, finally today, the market just puked. Today is August 1st, and the market just puked over the data and kind of coming to grips with the fact that, us pounding the table, the rhetoric, and by us, I mean more so like the government and the Fed. Oh, this labor market is steady and resilient and all of this and that. Well, adding basically zero jobs and staying flat is basically recessionary kind of results. So yeah, it caused, I mean, the front end of the curve to be down 25 basis points today, which is insane. And it flipped the probability of a cut in September from 50% to 80% in one day. So it's really interesting to see that data kind of finally, in my opinion, come into alignment with where it should have been. But, rather than kind of the market gradually adjusting to this reality, it just snapped today. And I'm sure it'll snap back, and, some sanguineness will re-enter the market and treasuries will float up a bit and then float down again. And that's the beauty of treasuries, unfortunately.